Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. On Fridays, I try and get this podcast up and going by 9 a.m. Eastern Time. I try and kind of talk about some of the things that I notice, kind of follow a lot of spaces in companies, and I'm trying to kind of highlight for investors from a value perspective. I know that's kind of for a long time saying that you're a value investor was like, oh my god, like no, like value is dead. But now I think that perhaps it turns out that actually paying for something less than it's actually worth may actually be worthwhile. So we have a lot of topics to cover, and I kind of try and highlight from my experience, to align you in a way of thinking about buying businesses and being an owner of a business and trying to marry this up with what's actually happening in the background as well. So we've got a lot to cover today. We're going to talk about the macro. Obviously, I'm not a macro investor, but it's the fact of the matter is that the macro here is a big thing. Tech, I'm going to give you a few examples how tech, as it transpires, was all just one trade. I'm going to talk about why I'm changing the way that I think about investing. And finally, I'm going to wrap this up with talking about commodity companies. So, macro, it's a mess. And, it's an absolute mess. You got global supply chains disruptions. You got, obviously, the invasion of Ukraine by Russia. You got a lot of media coverage, a lot of propaganda. It's misinformation galore. All around. It's an absolute mess with the amount of propaganda that even kind of quote unquote credited channels are talking about stuff. But I'm interested only about investing in this space and trying to navigate or helping you navigate this space as best as I can. I do this podcast for about 20 minutes on a Friday. I think this is a format that kind of works reasonably well from the feedback that I've got. I do it for two things. Firstly, I do it to kind of learn a little bit, because when I have to talk about stuff, I have to kind of learn a little bit about it. And also, when I kind of go through over time and synthesize my ideas, I try hopefully to improve my thought process. I'd like to believe, although this is, I don't really know, I'd like to believe that I'm helping somebody out there. I get some kind of regular people that comment, which I'm really appreciative of, because it's really motivating to hear, that I'm helping somebody, because it takes me time to kind of get this up and going. I don't get paid for this, so it's kind of nice to get some kind of feedback from people. Also, what I've learned from Charlie Munger is that it's much cheaper to learn vicariously, to learn from others about their mistakes, than it is to incur your mistake. And I've made every single investment mistake you can possibly think of over time. Every single one. I've done them all. But the one thing that I didn't do, the one thing that I actually surprisingly learned and picked up from every other value investor since the dawn of time, is don't leverage your portfolio. Everyone says there's one path to guarantee that you do not survive the 20-year game, it is to leverage your portfolio. You can do all kinds of crap, but if you leverage your portfolio, it's going to go from zero to hero back to zero. And now I hear so many people saying, I kind of leverage my portfolio, and I'm kind of like in a situation where what do I do? I'm so much underwater, I'm getting margin calls, what shall I do, And I'm saying, look, just you don't want to hear the truth. You want to hear that everything's going to be fine. I don't think that everything is going to be fine. You just got to rip that off, rip the band-aid off, and it sucks. I mean, it sucks for me as well. But ultimately, it is what it is. And I consistently say, don't leverage your portfolio. Don't play with options. I say to everyone, 95% of all options end up worthless. 95%. There's a 5% chance that it works out favorably. Okay. Now, you have a coin toss, right? You flip a coin, you get a 50% chance of kind of being right or wrong. So that's okay. Make an investment, 50% chance of being right or wrong, okay? Let's say. Now, if you leverage the portfolio options and you have a 90% chance that option works out worthless, Man, that's a crap reward. That's a really, really crap investment to make, where you have only a 5% chance of working out favorably. I mean, people brush this up and like kind of come up with really smart rhetoric. Cicero says that everyone has these kind of silver tongues, and I mean that they're kind of highfalutin with lots of rhetoric. But ultimately, when it comes down to it, you need to position yourself in a situation where you, as the investor, can put your personal balance sheet in a position that you can stay in the game, stay invested in the portfolio for a long period of time. Do not put yourself in a position where you kind of like, okay, I'm nervous, I need to react, the stock is down, stock is up, I need to do something. So like, that's, you're not going to get anywhere. You need to get yourself, first, align your personal balance sheet so that you can have some staying power for the next 2-3 years. That's the first thing. Secondly, get your portfolio into a position that it can really stay the course. I hope that that kind of helps a little bit somebody out there. Okay, the next thing I want to talk about here. So I've got, last week I talked about this, okay? I talked about, it's the one trade portfolio. I highlighted Wayfair, Teladoc, Block, Farfetch, Magnite. I highlighted a few different companies from a few different spaces, okay? Wayfair sells furniture online, has nothing to do with healthcare provider. Teladoc has nothing to do with Block, which is payment facilitator, has nothing to do with Farfetch, which is e-commerce play, has nothing to do with Magnite, which is supply driven platform for advertising. So I've tried to highlight several different names. All of them, you can see how closely they align, okay? It's just one trade, okay? Here's some new companies from DocuSign is reporting today, as you know. And you can see that DocuSign is up. DocuSign is up. The DocuSign name is never going to be up again. DocuSign is down 20% in the pre-market. And it's all one trade. Look, Palantir, DraftKings, DocuSign, PayPal, it's all the same. It's like we all kind of get ourselves caught up. And anyone that comes to me and tells me, as part of their investment thesis, that they are looking towards the management being really high quality, you are out, my friend. I like, that's it. If that's the first part of your investment thesis, you say management is really high quality, that's it. You have absolutely no idea what management is capable of. You may have tracked their kind of interviews on CNBC, which are PR polished. You have absolutely no idea of the capability of this management team that you may or may not have only known for about 2 years, and it's been in a very favorable environment, and now you kind of think to yourself, you look at these share prices going up, and the share price is going up, and the CEO is a star. It's just like moving like a star, even like the teeth shine. And then when the share price goes down, it's like, oh my god, that management team sucks. And it's just basically, you're just looking at the share price and building a narrative about the management team. You have absolutely no clue. That's the first thing. Okay? Be honest with yourself. The quicker you're honest with yourself, it's much better for everybody involved. The second thing to talk about is when people say, oh, the stock is now trading, the multiple is back to pre-COVID levels, so therefore it should revert back to the COVID levels. It's like, no, my friend, like please, the quicker you detach that line of thinking, it's going to be much better for you, okay? Look at a business in what it's capable of making at the free cash flow level per share, okay? Per share. This is so important. I talk about this every single week, and I mean, nobody kind of seems to care about these things, and then it's like the stock is down and everyone's like, oh, should I care about the stock-based compensation? I'm saying, yes, you should be caring about that. I always think about this, okay? Look at the amount that they're diluting the shareholder by. Try and get an estimation of what it's going to be at the end of the year. Add that to the share price. There you go, you got the market cap, and then think about what is the business actually capable of making on a free cash flow level, and how much is it just stock-based compensation. And I'm guilty. I invested in stuff that as well that will turn out to be really crap, and I'm here as well. And so it's not that everything is, I'm not pretending that everything is hunky-dory from my side. It's really not all hunky-dory. But if we're not learning from each other, what's the point of all this? Investing is a very humbling profession, because you're never as hot as your portfolio when it's hot, and you're never as bad as your portfolio when it's in the trash bin. So, you need a little nuances right there, but you need to kind of learn over time. You need to be able to learn new investment strategies. You need to, because the game and the rules are always changing. So I hope that adding this backdrop and adding this context helps somebody out there think about a little bit about tech investing. And trust me, cheap can always get a lot cheaper. I ate some nuts before the show and my throat is kind of tightening up. That's very annoying. Okay, so back in 2020, July, I wrote to the marketplace that I was changing my thought process, and that what had happened was that going into COVID, January, February 2020, I always had this hypothesis that if I was buying things very, very cheaply, on a very, very cheaply free cash flow basis, that as long as the business wasn't really, shrinking dramatically, if I was buying the business really, really cheap on a relative to free cash flow basis, that when the downturn would come eventually at some point, that the cheap stocks would go down less, and that the high, really expensive stocks would just fall like a rock. That's what value investors have been taught. That's what I followed. Turns out, when COVID happened, the cheap stocks fell just as much as the high growth names, and then what happened afterwards was that the high growth names hit the floor and just bounced really hard, and the cheap junky stocks remain cheap junky stocks. They never had a day back in the sunshine, and meanwhile the tech names were just like, wow, sizzling hot. And I kind of was able to understand that, and I was like, okay, I should pivot to understanding that it's actually probably worthwhile paying slightly higher multiple for higher quality businesses that have better margins, better free cash flow prospects, growing fast, etc., etc. You know all the place. And I realized that, and then I had a very good back end of 2020. It was like, everyone was making money, so it's like it wasn't me that that a genius or whatever. And what I was, so I had to change then. Everything that I thought, kind of deconstruct that, and you only learn really. I remember Carl Icahn quote, I can't remember how the quote goes, but basically, you only learn when you go for a bear market. Because in the bull market, everyone is a genius and everyone's tapping their backs. But it's only when you go for the bear market that you have an opportunity to really learn anything. Because you only start asking difficult questions when things go really badly sour. And I overstayed my welcome. I overstayed in tech, and I got punched in the face, and yeah, it sucks. And I can't wrap it up in any other way. I got really hit hard, and I have a choice of kind of lamenting, but or I could just say, okay, yeah, I messed that one up. What I should have done is I should have been a bit more diversified into other parts of the economy. And I thought that I was because I was investing in this type of tech business and that type of tech business, that I thought I was diversified, and it's announced that I wasn't. And when the market comes, and what I found really interesting, so if you're kind of a close follower of this podcast, which the two people that follow it, I'm really grateful for that, Brian and Taylor, thank you so much for your support. So I often talk about Upstart. So Upstart has everything going for it. Amazing revenues, SaaS business, operating margins, free cash flow. So Upstart has there is some elements of cyclicality to the business, but it's really a secularly growing business that facilitates the lending for the consumer. So it's not a bank, it's just a middleman that basically you go as a consumer and you want to get approved for credit, and you need to know where the bank needs to know whether this person coming to get some credit, whether they're credit worthy or not. So the way that people used to do it is you rely on the FICO scores, but the FICO scores are really faulty. They don't really give you enough context, enough history if the person's kind of starting out their business career or their professional career, and it's just faulty. And the way that Upstart does, they have 1,400 variables that they check out, and within a few clicks on the phone, they can tell you whether the person is going to default or not, up to a 0.4% default ratio. So normally it just gives you the ability to bring down the FICO score, so that facilitates the amount of people that can get capital lent to. And if you want to get some, let's say, a loan of, let's say, 50K, or if you want to kind of, now they kind of go into auto dealerships, if you want to be able to get access to capital quickly, and the bank wants to know this person will actually pay me back, and they would go to something like Upstart, and Upstart does this. So it has a lot of potential, okay? But the share price is getting killed. And this has taught me that it doesn't matter too much the quality of the business. When the market is going sour, it's getting killed off, and you can say, okay, yeah, things are really cheap right now, and it's kind of pointless to kind of change your path right now. And I'm not saying you need to change your path. I'm just saying you need to open your mind. Slightly different thing. And I look back, and everyone knows this story so well. You look back at the best businesses in the world. You look at the Apple, you look at Amazon. It's like these are the best businesses in the world. If you bought them in 2002, you'd have like just done a killing, yeah. But even from, let's say, the back end of to the 2000s into 2002, man, you're just going to get it smashed. And these are the one or two businesses that everyone talks about, that the survivors, these are the greatest businesses ever. But there's a lot of businesses out there that, just struggled to come out and didn't. Look, I was looking at Oracle this morning, okay? Oracle got smashed to bits, and now Oracle's kind of more or less okay-ish, right? It's much higher 22 years later from the dot-com bust, but, it kind of was inching around, and he's some of the best businesses in the world that we can have hindsight, we can extrapolate actually what happened, and you think to yourself, okay, you build a narrative on the back of what's happened, so you kind of resulting, you're looking at the end result, and you're working backwards to say, if only I'd done this decision, it would have worked out favorably. But you're working off hindsight, and you come building a narrative of incomplete information. You don't know how things would have played out. So long story short is that investing is a lot more tricky, and you need to be honest with yourself about that. And just to kind of talk about something that I believe is quite exciting is that I'm looking at commodities right now, and your first thought is like, whoa, momentum investing. And I'm saying, no, it's not about momentum investing. I should have realized in the past year and a half, these commodity businesses are in massive demand. Yes, Russia put the spotlight on this and brought my attention to this. I should have been, looking everywhere, but I couldn't. And I didn't. And, I can't cry about the past. What I know right now is that when I look at these commodity businesses, there are a few different things at play. First, for the past 10 years, commodities have sucked, okay? And the businesses that have been able to survive are the businesses that have positioned themselves the strongest ones, the leanest ones to survive. The second thing is, particularly in the past 5-6 years, China has not wanted to pollute their country as much as they work towards these ECG targets. They're trying to get the temperature rise to approximately 2 degrees, which is a bit higher than the rest of many countries sign up for the 1.5 degree. They've signed up for the 2 degree. But what China is trying to do is look towards green technologies. They don't really want to produce stuff as much, which is carbon intensive. And what's happened is that they're mass producers historically, and they're not producing as much right now. So China is not producing as much. The Europeans right now are struggling because the Europeans, they had also been embarking on these ECG investment strategies, and they're not investing as much. And also, particularly with the case of Europe, right now, their main inputs, which are, let's say, natural gas, are just skyrocketed. So it's become not feasible for those European businesses to produce stuff. Then you also got the problem that Russia's got sanctions all over the place. So you have very little supply coming on. China's not producing stuff. Europeans are struggling because they can't make it feasibly enough. The cost is it becomes prohibitively expensive, so they have to slow down their production. This leaves the Americans in a very cushy situation. And the Americans, for the Americans, you got very little inventory around, okay? You have the Biden bill, they want to build a bridge, they want to build a house, you want to build electric cars. All of that, you need components, right? You need aluminium, you need copper, everything. You need raw materials, right? So in the case of America, there's shortages of everything, there's a lot of demand because I said, the Biden infrastructure bill is just saying build everything that you can possibly think of. So you have a large amount of demand. From the American perspective, they've just survived 10 years of having to basically navigate this period with absolutely no capital coming in. So only the strongest have survived. So you have very, very clean balance sheets. Okay, so you have very, very clean balance sheets. Many of them with strong net cash positions. They're repurchasing a ton of their shares, and they're gonna make a ton of free cash flow this year. The ton. I mean, it's just gonna blow your mind because you have spikes in shortages everywhere. It's shortages galore. Now, I don't know how things are going to go over the next 2-3 years. I have absolutely no idea. But I didn't have any idea either how things were going to go in the tech space in 2020. And I had to kind of learn the lessons as I went, and it turned out that was wrong. But what I'm saying is you have to have some diversification into this space. And in the past, I was just too focused on looking at this one part of the economy. And I think that this is quite interesting. So over the coming weeks, you're going to see me migrate much more and talk about commodities going forward. So yeah, I hope you found this useful. Please drop me a like if this helped you think in anything, if you enjoyed this podcast. And yeah, don't forget what I'm going to say now, which is check out my marketplace called Deep Value Returns, okay? I would like to welcome you on board. I offer for you high quality, actionable investment insights. Thank you so much for listening. See you next time. Bye bye.